Yeah, I think there are really, really good opportunities in fixed income right now. To me, the best opportunities are in probably 5 years or 7 years and under Canadian bonds. So maybe also like a 5 year high quality Canadian corporates, or maybe if you want to take a little bit less risk.
Welcome to the Future Ready Advisor podcast. I'm your host, Sam Sivarajan, wealth management consultant and behavioral scientist. Join me and my guests, from industry experts to top advisors, as we explore the pain points that financial advisors face, how they can solve them, free up their time, and make their practice future ready. Hi, everyone. I'm Sam Sivarajan. Welcome to today's episode of the Future Ready Advisor. Today, I'm here with Konstantin Boehmer, a fixed income portfolio manager who is here to talk about the recent rapid rise in interest rates, the likely next steps for central bank policy, and opportunities for fixed income investors. Konstantin, welcome to the show.
Thanks, Sam. Thanks for having me here.
Delighted to have you. Let me quickly introduce you. Konstantin is Senior Vice President, Investment Management, Head of Global Macro and Quantitative Analytics, the co-lead of the fixed income team, and a portfolio manager at Mackenzie Investments. Konstantin focuses on actively managing global fixed income mandates using fundamental and quantitative and technical strategies. With a global personal and professional background, Konstantin is always looking for the next great adventure and global investment idea. Konstantin, I think this is a very timely time to have you on the podcast, given where we are with rates and central bank policy. Before we dive in, can you share with us a little bit about your journey and your personal investment philosophy?
Yeah, absolutely. That was a nice long intro with all of those cool words in there. But for for me, so my journey. So I'm born in Germany. I studied in the UK. Then worked with Lazard Asset Management in Frankfurt as a European fixed income portfolio manager. Then moved over with the same company to New York and went into global fixed income there. So managing global fixed income portfolios out of the New York office. Stayed there for another 4.5, 5 years, and then joined Mackenzie Investments here in Toronto, Canada, where I am. And initially managing global fixed income portfolios and launching the strategy for the company, but then subsequently maybe getting bigger roles and now looking after the fixed income team as the co-head. So, and maybe in terms of philosophy, so I think my journey has been important, right? Like looking at fixed income and investing in the different places that I've worked at makes, I think, a huge difference. Having the understanding that maybe Canada or Toronto is not necessarily the center of the world, but there are other important places, and that those areas are looking at the same problem in different ways. I think that is an important one. Also, different cultures, different ways of prioritizing what really matters. And that has also shaped how I look at investing and my philosophy around it. I think in terms of the macro philosophy that I share mostly is that we have to anticipate the changes that are not expected by others and therefore are not reflected in the price. So it is really like we have to have a good understanding of what is the narrative that we're trading right now, but mostly we have to do this so that we can anticipate what the next narrative will be, so that we can position ourselves already for what is coming next. And one great way which I employ all the time is just to visualize or conceptualize how the world would look like in 3 months' time or 6 months' time or in a year, and just try to detach myself from the present and put myself into the future and think how would the world look like in 3 months' time. And it's obviously not an easy one, but yeah, I think that works best for me in order to really find out how we should be positioned and what risks we should take.
Well, look, I think looking at different scenarios and anticipating is important in all walks of life, but particularly, I think, in terms of what you're doing, and in particularly in the time that we live in now. We've had an interesting and unprecedented run up in rates in the last 18 months. Now, we've seen that the Fed has held off with another rate hike, and so has the Bank of Canada. Stocks seem to have reacted favorably by and large, despite volatility. Can we expect, in your view, that we're done with rate hikes? Do you see further rate hikes ahead?
Mm, I maybe there's a short answer and a long answer. The short one is I think that's it for now. So I think policymakers don't necessarily want to hike more. We've seen now from the Fed, but as you say, also Bank of Canada, that I think they would like to be done, and they will be done unless data miraculously comes out significantly stronger and we get surprised by another round of exceptionally strong economic prints. And that is not in my cards to happen in the next few months. So therefore, I believe that we're done for now in terms of hiking rates. That's both for both major central banks that we talked about. The question, of course, then becomes, is that it for the entire cycle, or is that maybe just a temporary time period where maybe the initial shock to inflation and the resilience of growth are being dealt with? But I'm maybe my long-term view is that the inflationary pressures that we have experienced over the last few quarters to years are not going to away, because inflation is a little bit like toothpaste. Once it's out, it's very hard to put it back in. And I see a lot of worrisome signals still on the inflation side that uh, just don't jive well with this being a return to much lower yields. I think bond yields are like fairly priced, well priced at this stage, but there might be another run up in terms of higher yields in maybe a few quarters to years.
So that's interesting. So the question I was going to ask is, do you think that we will start to see rate cuts in the course of 2024, and how fast they will be? It seems to me that you're suggesting that the jury is out, perhaps, on whether we actually see rate cuts, and that it certainly seems like a long time before we get back to anywhere near the levels that we might have seen last year. Is that a fair commentary?
Absolutely, yeah. I think we have to distinguish between Canada and the US a little bit. Canada has a somewhat different trajectory in at least for me and the team that I have here. And like Canada being right, I think probably you know it well, your audience probably also knows it well, is we're in the global context one of the most heavily indebted households that we have. So it is not necessarily the government that is so heavily indebted. It is also, but it is also not the corporates, but it is the household sector, which has a tremendous amount of debt outstanding. It is, as you know, it is short in nature, right? So shorter maturities mean that it is more vulnerable to changes in interest rates. And then we also have an economy which is exceptionally heavily geared towards real estate, right? And real estate being one of the most interest rate sensitive sectors. So there's a lot greater vulnerability on the Canadian side versus the US. but oftentimes they are being like put together because they usually behave very, very similar. Biggest trading partners, obviously geographically super close to each other. And I think there's a reasonably large chance that there will be a proper divergence between Canadian central bank rates and US central bank rates. I think Bank of Canada will try to um, not go down that route, but I don't think they have a real chance. So I could see policy divergence where we see the US staying where they are and Canada starting to cut a fair amount next year because economic data in Canada should be meaningfully weaker than it is in the US, and therefore policy from the central bank should also be different.
That's an interesting comment. Maybe if we can explore that. To your point, there is such an interlinking between the Canadian and US economies. I mean, they are our largest export market. Uh, and we've seen in the past where when the Bank of Canada tries to diverge from Fed policy for too long, there's pressure on exchange rates,
Mm-hmm.
which obviously has an impact on our overall economy, given the export nature of our economy. How do you see that playing out in a scenario where there is policy divergence between the Bank of Canada and the Fed?
Yeah, yeah, totally true. Maybe if we put ourselves 6 months into the future, right? If we see Canadian economic data being significantly weaker and the US data actually holding up, I think the market will anticipate that there will be interest rate differentials coming our way. So the FX moves will happen probably before the central banks are actually acting on it, or the Bank of Canada is actually acting on it. So I could see a solid divergence also on that front, seeing Canadian dollar weaker. I'm not a like an FX expert, but I'm looking at it from the perspective of what is the most plausible path that it could take, and that to me is meaningfully weaker Canadian dollar that is being responded to by probably then following the moves in the currency would be Bank of Canada cutting rates. And because Canadian economy is so sensitive to rates, right? Maybe that is also revitalizing some of those spirits in the housing market. And so then maybe the growth, the forward-looking growth picture between Canada and US might be closing in a little bit, which could also to some extent limit of how far then the Canadian dollar should weaken. It is not a given that just because the interest rate differential is wide, that it is a one-way street, right? It is currency or any market is usually anticipating what will happen in the future. And if you see that those interest rate cuts might lead to some success in terms of revitalizing the economy, right, then that would be generally seen as a positive environment and might stem the losses of the Canadian dollar. So that is like the different stages of the narrative, right? The narrative right now is still Canada and US are pretty much the same, and that should evolve, in my mind, into the next narrative, which is Canada and US are not the same, and that would be probably the weakness of the Canadian currency part. And then the narrative that could come after that is, wow, okay, Canada, Bank of Canada has reacted. Maybe we are seeing now Canada being revitalized and growth coming back to some extent. Obviously, not in the areas that you want it to be. You don't really want more housing and more appreciation in that part, but it is a quick fix to get growth back up.
Yeah, I think that's an interesting viewpoint that the narrative and the scenarios are changing, and it goes hand in hand with what you said at the outset, that you kind of have to put yourself in a position to look at the different ways that the market and policy can evolve over the next 3, 6, 9 months, and no one has a crystal ball. But I think that's an interesting scenario that you point out. So, extending that thinking a bit, given that long rates are currently high and that there is a possibility, certainly in the Canadian context, that we can expect rates to start coming down. Is this a once in a lifetime opportunity for investors? I mean, to buy long bonds that are generating high coupons and then realize capital gains along the way? What do you think?
Yeah, I think there are really, really good opportunities in fixed income right now. To me, the best opportunities are in probably 5 years or 7 years and under Canadian bonds. So maybe also like a 5 year high quality Canadian corporates, or maybe if you want to take a little bit less risk, like a 3 year Canadian corporate bonds. Those are, in my opinion, fantastic because that aligns quite well with the view of Canadian economy weakening, Bank of Canada probably having to act on that, and you're buying an asset which has some duration. So you would benefit if they were to cut. You would benefit if interest rates were to come down. You're not in the super risky part, so you're not in the high yield. So you're not fearful really of any kind of impairment on your bonds, right? So that there will be any defaults. So staying in high quality probably makes a lot of sense. But then also staying a little bit shorter. And the reason for that is that usually when you have central banks cutting rates, it is the biggest bang for your buck. You get kind of like in that 5 year part of the curve, like the yield should drop the most in that part of the curve. The reason why I'm not too fond of long-term bonds is maybe number one is that like Canadian 30 years are now at 350, right? So they have come down already quite a bit. It is not overly attractive from that sense. They're actually 115 basis points lower than 30-year bonds in Canada. So there's a big divergence already between Canada and US, somewhat reflecting that there are more problems in Canada than there are in the US. And I am again speaking in maybe the different stages of how that could all play out. I think in the first stage, everything, all the bonds will rally if there's economic weakness coming our way, and the anticipation of the Bank of Canada cutting rates is increasing. In that scenario, our response in markets will generally be all the bonds will be bought. Like every government bond will be bought. So 30 years will rally, 10 years will rally, 5 years will rally, 2 years, 2 year bonds will also rally. So the whole curve will shift down. But I think there's the next stage is, well, who's gonna pay for all of that? Who's like, is that additional bond issuance, especially when there's weakness of the Canadian dollar, like how is that all gonna work out? Because it is one thing to cut rates and to increase spending to support the economy from a fiscal side during times when budget deficits are low and overall debt levels are reasonable. If you are at a stage where maybe one or two concerns are there, like whether that is even possible to save a big economy like Canada, that right market participants might sniff that out and are aggressive in terms of maybe looking at long-term bonds and saying, I don't know if I really want to own Canadian risk for 30 years. Maybe I feel more comfortable in shorter maturities. I'm not so sure about the longer ones because maybe the health of the Canadian dollar, the health of the Canadian banking system, the health of government finances isn't as stellar as maybe the rating agencies are suggesting, which is like still prime for Canada.
I think that's a great point, and I'd like to explore that a little bit. I think you touched on it before, but if we shift our sights to a little bit longer term view, like beyond the 5 year, 10 year view, what is your longer term view for the fixed income market in Canada? Given, as you point out, that the levels of personal, corporate, and government debt is very, very high, that we're entering a period of economic weakness, do you see any systemic risks to the economy in general, but the fixed income market in particular, given some of these factors that we've just touched on?
Yeah. So I think in general, there are really three ways to meet. It's not my quote, it's I think from Hoover, but there are three ways to meet unpaid bills for a nation. The first one is taxation, so tax people more. I don't know how you feel about that, but I feel we're pretty much there. The second one is it's got repudiation, but it is defaults. So defaulting on your debt. If you have too many unpaid bills, like that clearly is an option. And the third one is inflation. And I am probably the most fearful that it will be like they are sure they will try taxation, but I don't think that is a real option to make meaningful changes. So I think the third one is inflation. And like as I said with the toothpaste, that is the one that I'm most worried about because when like all of us we that are in markets now, including me, right? We haven't really lived through in our professional careers through inflationary time periods. Maybe some of us have lived through them in other countries, right? So, um, not necessarily in Canada or in US, but maybe if right, some of your listeners are maybe from some places in Latin America or some other areas where inflation has been prevalent for many times. So we haven't really lived through inflationary episodes here in Canada, in the US, or in Europe in our professional lives. And I just think that it is very hard after 2 years of meaningful inflation that this is just easily getting back into the rhythm of 2%. And right, we've seen some structural changes on the inflation side where we had globalization having such a huge impact of driving inflation down that clearly has shifted over the past few years. But then you have multiple factors as well. And now we are, I think, at a stage where, especially in the US, but to some extent also in Canada, where we look at wage negotiations that are at exceptionally high levels. In Europe, it is no different. In Japan, it's also the highest in 30 years. So when that kicks in, right, that is the wage price spiral where higher wages are leading to higher prices, and those higher prices serve then as the primary argument for asking for more money on the wage side. And to kill those, you need to have a real recession. And you need to have probably a meaningful increase in unemployment. And if you are the central banker that kind of says, are you okay with the current levels of inflation, which are more 3 to 4%, or are you willing to maybe in the US case sacrifice 500,000 jobs to bring it down to 2%? Right? It sounds a little bit extreme, but that is almost the equation that they have. It's like you need to have a meaningful increase in unemployment and people losing their job to really kill that wage price spiral. But if you're not willing to do that, then it is also very hard for inflation to come down to those levels of 2%.
I think that's a really, really good point. And we've seen, I guess, the most recent example or experience that we've had of that in North America is in the 70s and 80s. And it took a very long time, as you said, and some significant austerity measures to break the back of inflation then. So I think your point that this is suddenly going to go away is, I think, perhaps a little bit of wishful thinking. I think the question for policymakers, investors, and I think the electorate as a whole is simply which poison do we want to take over the longer run, right? And I think your point about whether it's Hoover's quote or not about those three ways, I guess you're right. Taxation, I would say most of our listeners would agree with you and me that we're probably as high as we want it to be. I don't know whether the policymakers would agree with that, but I think that's one. And I think repudiation, obviously, for any government that wants to tap the markets for the foreseeable future, that's not an option, really. So inflation is the third. And perhaps I might venture there's a fourth option that could go hand in hand with inflation, which is simply reduction of entitlements, right?
Yeah.
As in cut back the benefits, cut back the services. And we see shrinkflation happening in the grocery store. I mean, there is a version of shrinkflation in my mind that you could see in terms of public services that we might be experiencing.
Yeah, that is a great point. Yeah, I agree. I think the aspect here to consider is everyone wants to get votes, and those votes are often tied to those entitlements. So they have to also be smart about which ones to cut without hurting their popularity all too much. But yeah, another option. Yeah.
This has been a fascinating conversation, Konstantin. I think if I could summarize it, I guess we could say that there's an interesting inflection point. I think the next 6 to 9 months will create a little bit more visibility in terms of what might lie ahead, but there are some investment opportunities in the medium term side, I would say, from my understanding. We're coming to the end of our podcast, and I wanted to wrap it up with a few final questions for you, which I ask of all my guests. So, in rapid fire format, the first question is professionally, what is the most important lesson you've learned over the years?
Most important lesson. I mean, I just think in general, you just have to put in the work. Like nothing good comes out if you don't put it in. You have to be dedicated. You have to be focused on doing whatever job is that you have, whether that is doing the podcast or investing in markets. It is nothing happens with just doing the job half. You have to do it fully, and you really have to be committed, and you will get the results sooner or later.
That's a great insight. I think it reminds me of something I just seen that somebody wrote, which is that the path to success isn't an elevator, it's a staircase.
Yep.
Number two, what is one practical tip you would offer listeners keen on applying your insights?
Oh, a shameless plug would be a great one. So I'm on LinkedIn, and I do write about my views on fixed income markets. It is not going through all the channels of a big fund company. It is really just my views. So they come up, I write them down, I put them out. I'm not trying to sell anything. I'm just saying this is what I see in the markets right now, and here's why I think it's important. So Konstantin Boehmer on LinkedIn. Yeah, look me up and just connect.
And I can heartily endorse it for all of the listeners. I mean, I'm a big fan of Konstantin's posts. I think they're interesting, they're funny, and they're certainly insightful.
Thank you.
Number three, Konstantin, any parting words of advice for our listeners?
Yeah, it is. Investing is a difficult game, and I'm generally of the opinion that people have to know what they're good at and also have to understand what they don't know. And in terms of fixed income, like speaking to plenty of advisors, that is for many a black box still, because it is complicated, it has so many nuances, and at the same time it it makes a difference, but it is reasonably low in terms of the volatility. So maybe in equities, pays more to be completely in that market and understand that market and the nuances in and out, because the volatility is so large. In fixed income, it is clearly lower, uh, less so in the past couple of years. But I think it is looking at good managers to that you can hire to do the job for you. I don't think it makes any sense to own bonds individually. It like if you don't want to manage them, put them in a passive ETF or put them in some fund that is actively managing for you. Because for advisors, I think one of the biggest value adds that the advisors have is being there when things are tough for their clients. And in those moments when things are tough, you don't want to have overcomplicated portfolios. You just want to be able to make quick changes, sell that fund, buy another fund, sell that passive ETF, buy another passive ETF, and spend really the time more on holding your clients' hands as opposed to figuring out how to trade a 2027 3.4% bond that is illiquid for you to get any kind of good prices on. So I think it is look for your value add, focus on your value add, and I'll do my value add, which is just managing fixed income portfolios.
I think that's great advice. I think particularly given everything that you've said about where we are right now in the rate cycle, all of the both opportunities and challenges ahead, I think having a managed bond portfolio, whether it's passive or active, probably makes sense for most advisors and most investors. Konstantin, this has been a really fun discussion and some really, really interesting perspectives on, I think, macro and micro issues. If listeners want to learn more about you or find your work, where do they go? I know you mentioned the LinkedIn, but if you can give that again and any other source, I think that would be great.
Yeah, so LinkedIn, Konstantin Boehmer, that's Boehmer, working at McKinsey. Otherwise, yeah, sure, McKinsey, obviously a big fund provider. So I'm sure there's a wholesaler that you can reach out and maybe also come by. We have conferences where we go throughout the country. Just come by and say, you heard me on Sam's podcast, and then we'll just get in a conversation and see where that takes us.
Awesome. Konstantin, it's a pleasure to have you on the podcast and talk about something that is very interesting and timely, I think, for most of our audience. So thank you.
Thank you, Sam, and hope to do it again.
In this episode of The Future Ready Advisor, I had a timely and interesting conversation with Konstantin Boehmer, co-head of the fixed income team at McKinsey Investments. Here are my 3 key takeaways from the conversation. Number 1, anticipating change. Konstantin's macro philosophy centers on anticipating unexpected changes not yet reflected in market prices. By visualizing the future and understanding evolving narratives, he seeks to position portfolios to adapt to upcoming shifts, particularly in a rapidly changing interest rate environment. As the old saying goes, we need to go where the puck is going, not where it is. And in the rapidly changing economic landscape, this is critical. Number 2, the rate hike outlook. While acknowledging recent rate hikes, Konstantin shares his belief that major central banks, like the Fed and Bank of Canada, may pause for now. He discusses potential factors that could lead to future rate hikes, highlighting the delicate balance policymakers need to have to navigate between fighting inflation and ensuring economic resilience. Number 3, divergence in interest rate policy. Konstantin anticipates potential policy divergences between the Bank of Canada and the U.S. Federal Reserve. With the focus on medium-duration bonds, he suggests that the economic vulnerabilities in Canada may lead to rate cuts, offering opportunities for investors. However, there are potential clouds on the longer-term horizon. underscoring the need for a strategic approach in fixed income investing. Thank you for listening to this episode of the Future Ready Advisor. Please be sure to subscribe to this podcast, and if you could rate it while you're at it, I would appreciate it. Visit samsivarajan.com, where you can download a behavioral coaching guide and find other resources. Join me in the next episode for more tips and tools to make your practice future ready.